I have been a professional trader for over 26 years, and today I'm going to reveal the one thing about candlesticks that most people don't realize until it's far too late. If you want even a fighting chance at reaching the big time in this industry, you must master the art of reading candles. Without this knowledge, your career in the markets will be short-lived. Most traders mistakenly believe that candlesticks are just about price action or the battle between bulls and bears. They aren't. It's actually all about emotions. Specifically, it's about decoding the emotional context simmering beneath every single candle. Once you learn to crack this code, which is surprisingly simple, you will possess a massive edge over the rest of the market. So, if you're tired of guessing, tired of chasing every move, and tired of feeling like you aren't cut out for this, I need you to stop. Right now. Watch this video closely, because I am about to give you a definitive masterclass on how to truly read candles. 2. The 4 pillars of candlestick anatomy. Our agenda today is straightforward but incredibly powerful. We'll start with the 4 pillars of candlestick reading: color, body, wick, and range. Color. Green candles generally signal strength or buy-side momentum, showing price moved up during that period. Red candles indicate weakness or sell-side pressure, showing price moved down. The body, this is the rectangular section. Every body has an open and a close. On a green candle, the open is at the bottom and the close is at the top. For a red candle, the open is at the top and the close is at the bottom. The wick. These are the lines protruding from the top and bottom, also known as tails or shadows. The top of the wick is the highest price reached. The bottom is the lowest. The range. This is the total distance from the very tip of the top wick to the very tip of the bottom wick. 3. Pillar 1. The significance of the body. Let's dive deeper into the first pillar, the body. I categorize these into 3 types: large, small, and doji, little to no body. Large-bodied candles. Generally, the larger the body, the stronger the momentum. But here is the trap. These candles are often aggressive and fast. Their impulsive nature creates a split-second illusion of certainty. Amateur traders see a giant green bar and think, "This is it. I have to jump in now." This is almost always a mistake. Instead of looking at the price, look at the trader type. Ask yourself, what kind of person is buying or selling right here? If you see a massive green candle, a disciplined pro using technical analysis isn't buying at the very top. There's no valid setup that high. That means the people buying there are amateurs reacting to FOMO. This is why large candles often fail. The higher the emotional intensity, the less sustainable the move. Emotion is the abandonment of intellect, and that is where the winners separate themselves from the losers. 4. Pillar 2. Small bodies and wicks. Small-bodied candles and doji represent indecision to the masses, but to me, they represent opportunity. When I see them, I think, something is brewing. The market is coiling up like a spring, getting ready to explode. I want to read between the lines and front-run that explosion. However, the most critical part of the candle is the wick. Nothing signifies a trend shift or a sentiment reversal faster than a wick. Take a look at this chart. You see a wick that represents a 90% price retracement. This isn't just buying, it's authoritative, aggressive commitment. When you see that much strength, the end result is almost always higher prices. 5. The secret hidden in plain sight. There's a tiny secret on the charts that I want to see if you can spot. Look at the candles right before a major reversal wick prints. What do you see? It's usually a large-bodied, impulsive candle. As we just learned, large-bodied candles represent emotional intensity, and emotional moves rarely stick. So, long before that wick even appeared on your chart, you could have predicted it was coming because you saw the emotional exhaustion of the previous move. That is a significant edge. The same works in reverse. 2 back-to-back top wicks after an impulsive move up almost always lead to a drop. 6. Pattern number 1, the John Wick, hammer/inverted hammer. Now let's talk about my 3 favorite patterns. First, the John Wick, my name for hammer or inverted hammer candles. The significance of the John Wick is the sheer aggression of the price change. At one point, this candle was a full-bodied red bar. It looked like the market was imploding, and everyone was panicking to sell. But then, snap, it got picked up aggressively. The amount of money required to lift a stock off the floor like that is astronomical. We're talking millions or billions of dollars in volume. That kind of intent doesn't just disappear. The entry. I use 2 methods. The aggressive way is buying once the candle claws back 30% to 50% of its range. The safer way is buying when the next candle crosses the high of the John Wick. The stop, always beneath the low of the candle. The target, at least 50% to 100% of that candle S range. 7. Pattern number 2. The power tower, engulfing candles. Next is the power tower, also known as the engulfing candle. When you see a massive emotional fear candle, large red bar, it's often too late to sell. Instead, I look for the reversal. If the market can retrace 30% to 50% of that large red bar, that's my entry signal. This doesn't always happen in a single candle. It might take 2 or 3 bars to reclaim that territory. The concept remains the same. We are looking for the market to prove that the initial panic was an overreaction. Once that 50% threshold is crossed, we buy with a stop at the low, targeting the top of the initial range. 8. Pattern number 3. Rising and fading wicks. My third favorite is the rising support wick, or fading wick for shorts. The answer to what happens next is usually found in the series of candles that came before. In a downtrend, you might see a series of candles where the tails, wicks, are gradually trailing upward, almost like they are grinding or walking up. This signifies building pressure. It's as if an algorithm is nibbling at shares, scooping up every dip. This coiling effect only needs a break of the upper range to send the price off to the races. We buy the break of the candle structure, with a stop below the low of the day, targeting the upper range. 9. Addressing the losses and risk reward. I know what some of you are thinking. You're only showing the winners. I get it. But here is the core of the theory. Because we are entering after big emotional moves with stops at the highs or lows, our risk is tiny compared to the potential gain. While 99% of traders are out there chasing 1-to-1 or 1-to-2 risk-reward ratios, these setups produce 3-to-1, 4-to-1, or even 5-to-1. You don't have to win every time when your gains are that much larger than your losses. Yes, there are losses, but because you understand the emotional context, your winning ratio stays high and your losing trades stay small. 10. Closing and resources. I truly hope this makes sense to you. This is one of my favorite subjects to teach. Before we wrap up, I want to mention a few things. My wife and I run this channel, and we've put together a free weekly watch list called the Gains Guide. It covers the best technical setups for the week ahead, and the link is in the description. Also, many of you know we've started our live trading community. I love trading live and narrating these exact scenarios in real time every day. If you want to escape the hamster wheel of existence and get hands-on education, click the links below and join us. Thank you so much for your support. Until the next one, take care, trade well, and cheers!